Good morning, good afternoon, good evening, wherever you're watching this. It is Chris Carlin here from Vista Financial Group and Master Your Money Now. Hope you're well. Hope you're having a fantastic week. Very excited to present this webinar to you on self-managed super funds, SMSFs, the ultimate investment vehicle for self-directed investors. We're going to get started in about 12 minutes, so if you're watching live, grab yourself a cup of coffee or whatever it might be, your lunch, whatever, and we'll have a chat in 12 minutes. If you are watching the recording, fast forward to about the 12-minute mark, and then we will get started. But in the meantime, let us know if you're watching. Make sure you give this video a like, you subscribe to our channel, check out a few of the other videos that we've done, and also leave a comment with any feedback, questions, nice things that you want to say. It would be greatly appreciated. So again, we'll be going live in about 11 minutes and we'll see you then. Good morning, good afternoon, good evening, wherever you're watching this. It is Chris Carlin from Master Your Money Now and Vista Financial Group, and very excited to be joined by the managing director, I think your official title is, of Vista Financial Group, Tyson Roberts. How are you?
I'm well. We have had previous conversations, including on the last webinar, where we don't refer to myself as the boss, but I'm well.
Oh, right. Okay, fair enough. Apologies. I'll hear about that one later. But yes, so thank you for joining us on this topic that does come up quite a bit about self-managed super funds. What are they? Are they the right vehicle for you? There's a lot of information going around there, but hopefully we can cut through a lot of that noise and show you step by step as to whether this is the right thing for you. And if it is the right thing for you, why you should do it. And if it's not the right thing for you, where we should go as well. Because it's self-managed super funds. They're right for some people, but they're not right for everyone. Yep. So we'll just wait for a couple minutes for a couple more people to join. But if you are watching us live, let us know in the comments that you're watching and where you're from. If you've got any questions, let us know. And if you're watching the recording as well, feel free to leave some questions there. We can respond to them after this webinar goes live. Make sure you give us a like on and follow on your favorite social media channels. They're all listed in the links in the comments, and make sure you subscribe to us on YouTube as well. So let's just start the presentation. So the usual disclaimers all listed there. Effectively, with this discussion, we don't know you, we don't know who you are, so we're only going to tell you what you can do. If you want to talk about what you should do, i.e. personal advice, get in touch with us. We will talk about how to do that at the end of this presentation. Myself, for those who don't know me, I've been in the industry for 11 years now. Was the founder of Master Your Money Now, which was acquired by Vista Financial Group approximately 6 months ago now. Just with a young family, it was just the right time to pass it on to Tyson, who can run that side of things and go from there. But yeah, built up, been known for looking after nurses and teachers in particular. And like I said, I've got a young family, 2 little girls that keep me very, very busy. So, and Master Your Money Now, I said we started 1 July 2018. We specialise in online financial advice before COVID made it famous. And again, our primary client base was millennial nurses and teachers who, I'll be honest, probably didn't use self-managed super funds all that often. It probably wasn't the right fit for them, but that's where Vista Financial Group got a bit of a different background, can go through that. But Tyson, why don't you tell us a little bit more about yourself and your backgrounds and why you're an advisor?
Yeah, so my background's a little bit different to Chris's. I started out in corporate, spent a bit of time. Well, actually, I started out in accounting before progressing into corporate and more on the management side of financial advisors. And that's where I came across Vista Financial Group. I met with the firm, Chris Carroll and the team in 2011, actually, is when that relationship started. And in 2018, Chris's wife actually approached me and said, would you be interested in joining the team? And for me, it was a no-brainer. Joining a really successful and established financial planning practice with really good people. So in 2018, I joined Vista as a financial advisor. And in that time, we've changed quite a bit. Financial advice in 5 years, it's obviously coming out the back end of the Royal Commission.
Yes.
The old filing cabinets. Yes. When I started out at Vista, we had the filing cabinets. So it's become it's a really big change that we've made over the last 5 years, but it's in a really strong position to be able to service clients of all stages of life. And we've deliberately approached it that way, and part of the reason for the attraction to Master Your Money Now, outside of having really, really good people, was around the millennial client base, which allows us to service a demographic that we probably didn't have significant exposure to previously. So now we can service millennials through to pre-retirement, through to retirees, through to aged care. So we've got an aged care specialist as well, Sonia, in our office down in Beaumaris. So we've been really, really pleased with how that's played out. And self-managed super funds are a really key component of Vista Financial Group and our service offering. So really excited to be here today to talk through that.
Yeah, like I said, you really can help everyone from millennials who are just starting their wealth all the way up to retirees, high net wealth clients, all the way to the aged care, which Sonia does a great job in doing that as well. So whatever your needs are, let us know and we can put you in touch with the right person. So, but we talked about it, and this is what we all want to know about. Let's start off with the bare basics. Tyson, explain to us in everyday language what a self-managed super fund is.
Yeah, so obviously a self-managed super fund is a much more technical approach to managing your superannuation, undoubtedly, and we'll cover off on that today. But effectively, it's a really good way to take more control of your retirement savings. So what it allows you to do, if you're a husband and wife, for example, or any relationship really, you can pool your money together to allow you to invest your retirement savings in a manner that you would like to. So in the background, it's guided by what we call an investment strategy, which we'll talk about. But it allows people to invest in assets that they might not be able to in their current superannuation fund, which could be like an industry fund or a retail fund, think big banks or the likes. But a self-managed super fund ultimately allows you to take more control of your retirement savings, and particularly around how you want to invest those funds.
Sure, yeah. So it's someone who's, you said control, I mean, it's someone who's very engaged and wants to have a bit more management and direct involvement with their self-managed super funds, which I would probably suggest that 80-90% of people don't want that. They don't want that. They want someone else to manage all that side of things. So who typically does have or wants a self-managed super funds?
Yeah, good question. Because these days we probably wind up just as many as we open up self-managed super funds. So if I step back from that and answer it from existing clients, we tend to find most clients that already have a self-managed super fund, they've invested in one of three things. Australian property, so they might go and buy a commercial property. More so than residential, we see commercial properties inside a self-managed super fund. They either have cash and a lot of cash, or they have a direct share portfolio. Because if you go back a number of years, it was really difficult to actually borrow to get a property inside a self-managed super fund. So people used to do it to allow them to buy direct shares. Now, the superannuation environment has improved with technology, and there are platforms that allow people to invest in direct shares a lot more cost effectively than via a self-managed super fund. So we tend to find that a self-managed super fund these days tends to be people that want more control, and that might be to allow them to buy a real asset. So for example, self-employed people, we have a lot of clients that are self-employed, and they might have the self-managed super fund to allow them to buy the factory that they work in. We've had some extreme examples over the years, to be honest, where one client wanted to invest in physical gold. So obviously you can't do that in a retail fund. You need a self-managed super fund to allow you to actually buy the physical gold. But as part of that, you've got to store it somewhere. So just keep in the back of your mind, sure, a self-managed super fund allows you to take more control of how you invest that money, but you can't use it for your personal benefit until you meet a condition of release. So that means that it needs to be for your retirement. So in that example of physical gold, that would mean you need to put it in storage. You can't be showing it off to your friends in your house. It needs to be in a vault. So we tend to find people these days that are looking to start a self-managed super fund, by and large, are looking to take more control, and that generally is to buy property. That's the key consideration that we find these days.
Yeah, and without going through a full history lesson of the superannuation industry, but in 30 seconds, like when superannuation started, it was originally controlled by the big banks, generally speaking, retail, which got it started. Then industry super funds came in, which significantly reduced the fees, and rightfully so. And then self-managed super funds became in, which gave people more options. And you know, industry funds responded to self-managed super funds, retail responded to industry and self-managed super funds. And now, is it fair to say we're in this situation where unless you wanted, because I always came from the viewpoint that unless you wanted to invest in direct, the only thing you can't do in a normal industry or retail fund in comparison to a self-managed super fund is invest in direct property or something extreme like gold or art or something like that. Is that a fair summation?
Yeah, agree. It's there's a thing called a wrap account, WRAP, that were introduced. They've been around for a while now, but they're becoming more and more prominent. And they allow investors, and if you've got an advisor, it's reasonably straightforward. You have to be a sophisticated investor otherwise. But they allow you to buy direct shares without the rigmaroles of a self-managed super fund. So technology's improved to allow people to house their retirement funds in different options now compared to what it was 10 years ago, where to buy direct shares, you previously had to have a self-managed super fund. These days, that's not necessarily a requirement.
Yep, excellent stuff. So that gives a bit of understanding of who it's for, who it's not for. But let's say, we want to go down the self-managed super fund path for whatever reason. Let's talk about some of the key attributes of a self-managed super fund, because you mentioned the proverbial couple that can pull their finances together and get some scale or a bit lower fees sometimes, whatever they want to be. But it actually could be more than that. It's because the legislation changed only very recently. I can't remember when. Where you could have had, originally it was only 4 members of a self-managed super fund. It can now go under 6, can't it?
It can, So that allows you to bring, mind you, we don't see a lot of people that have 6 members. It tends to be 2 generally, but there is the option to have more. So that allows you to pool your money together, and obviously more money provides greater options for investments, because it's the rules inside a self-managed super fund. It's just a bit trickier to get borrowing, and we'll touch on that a little bit later. So the ability to have multiple members is an option to pool your money and allow you to have greater scale for buying into commercial property or whatever it may be.
And do those 6 people need to be related?
No.
So it can be anyone. It could be your neighbour, it could be your boss or whatever around the road. So I mean,
it can be. Always be careful who you're getting into a self-managed super fund with. But you do have the flexibility.
Yep, fantastic stuff. So now talk about trustee. Now that trustee word is a bit of a scary word, but what does it mean by a trustee arrangement, particularly the role of a trustee? What does that mean?
Yeah, so if you think of, if you've got an industry fund today, it's pretty much set and forget. You can just, it just rolls on, you make your contributions, your employer puts money in, you choose your investment option, and you're pretty happy. With a self-managed super fund, the role of the trustee is to make sure everything's in order. So there's different trustee types, which we won't touch on today, but it is a more onerous process to be the trustee of a self-managed super fund, because ultimately you're signing off on the financials, that they're true and accurate. You're choosing the investment options. Now that can be through an advisor, and for a component of the listeners today, an advisor would probably be appropriate. For others, they're quite astute investors and comfortable making their own decisions. But the role of the trustee is to make sure that the self-managed super fund is invested how it should be, and that you're meeting all your reporting and legislative requirements, essentially.
Yeah, and I think probably another way to put that is, when we used the word control before, it's probably maybe another word we could use is responsibility. Yeah. Ultimately, if something goes wrong, if you're with an industry fund or retail funds, which we've seen, sadly, a few instances in the past where that's not been the case, they're the ones that get in trouble. Whereas with a self-managed super fund, you're in control, you take responsibility. If something goes wrong, it's on you. So, and that can be a positive, and it could be a negative as well. So it really depends on your personal situation, how comfortable you are with that responsibility, whether that is the right thing for you. So, but let's talk about the tax side of things as well, because what are some of the more, as we know that superannuation is usually a very tax effective vehicle. In my view, it remains probably the most tax effective vehicle that's available to everyday Australians before we get into some really complicated stuff. What are some specific tax advantages of a self-managed super fund that you can have that may not apply to a standard industry or retail or other everyday super fund?
Yeah, so for a start, it comes back to control, and I know we keep touching on this. That's a significant benefit of a self-managed super fund. So if you let's say you've got a direct share portfolio. What it allows you to do is manage your tax position. So if you've got CSL's the classic example, or Macquarie Bank or CBA, but CSL in particular, if you've got a significant capital gain and you've bought your shares over time, a self-managed super fund allows you to massage those numbers within the rules, but selling those that have the least capital gains, for example, early on, and then maybe holding on to the rest until you're in retirement, which could be a tax-free environment to allow you to sell those shares tax-free. So a self-managed super fund just gives you more flexibility in that regard. For the self-employed, without getting too technical, there can be some ways to essentially buy the factory through the self-managed super fund and then rent it back. There can be some tax benefits there as well. But in the long term, it's around largely around the tax concessions inside the super environment in general. That's the big advantage. And obviously that means any earnings, distributions, dividends are taxed at 15%. Capital gains are also at 15%, but if it's held for 12 months, it pulls back to 10%. So they're the big benefits, but there are a number of benefits, particularly relating to that control factor inside a self-managed super fund.
And I think particularly when you're going from accumulation phase to pension phase, which for my standard millennial nurses and teachers are a long way away, but if you've got some long-term planning, and for example, the property, commercial, residential, whatever it might be, and you hold it long-term until you go from accumulation to pension phase, because in pension, you said 10%, that applies in accumulation, but in pension phase tax-free, if you hold it for that long, my understanding is the tax is nil.
Yeah, correct. Once you meet that condition of retirement, and assuming your balances are below particular levels, there are some rules around that. But you're exactly right. And that CSL example again, if you sell some shares now with the least amount of capital gains, hang on to the ones with the bigger ones, assuming you don't want to sell the whole lot, and you do that in retirement, assuming you meet all the other rules. It could be a tax-free benefit.
Which it can be many thousands, tens of thousands, potentially hundreds of thousands that you can legitimately claim as a tax minimisation strategy.
Yes, because those assets stay inside the self-managed super fund. The move to a pension account is just a technical piece in the background that the accountant takes care of. Whereas when you're in a retail or an industry fund, you've got to sell the whole thing down and move it across to a new investment. And naturally in the background of retail and industry funds, they're realising capital gains all the time, and you just pick up a share of that.
So they're already triggering those capital gains because they're not thinking about you specifically. They're thinking about you who might be going into pension phase, but also thinking about the millennials who are just starting, and this capital gains is not really a consideration. For them. So that's where it's not it's more of a broader approach, where a self-managed super fund can get very personalised.
Correct, and this is not material, but every time you put $1 into a master trust fund, which is an industry fund or a retail, you're naturally incurring a little bit of unrealised capital gains in the background, because you're just part of the family, essentially. Whereas when you're in a self-managed super fund, if you buy a share today, say it's CBA at $90, whatever, your purchase price is set at that point. So the control factor is significant from a tax perspective as well.
Excellent stuff. So again, hopefully, I know we got a little bit, went down a little bit of a rabbit hole there, but hopefully it makes sense. And if you do have any questions either now or later, put them in the comments below, or alternatively, we can have a chat with one of our team and we can go through those. We'll give instructions on that later. So we've talked a little bit about some of the investments. We've talked about how funds and how the fund will operate, how the funds are investments. Talk to me about, we've also talked about investment choice a fair bit as well, but talk to me, Tyson, about the investment strategy, because I know that gets talked about a lot and it is a very important requirement. Tell us what's required from the investment strategy, because I imagine it would be, generally speaking, pretty straightforward, or is it?
It is. So an investment strategy just sets the framework or the guidelines for how the money needs to be invested. Now, as the trustee of the fund, obviously you control the wording that sits under that. So if you've got a bias for property or whatever it may be, you can massage the investment strategy to fit that. I think in recent years there's been I'll call it a crackdown on investment strategies because they were too broad. So we are seeing a more defined investment strategy moving forward. A key term that needs to be included in any investment strategy is around diversification. But really it sets the guidelines around how much you're going to have in cash, how much you're going to have in fixed income, how much you're going to have in Australian shares, how much you're going to hold in international shares, and how much property and infrastructure. So that document is really important for the day-to-day running of the self-managed super fund and picking and choosing where you want to invest those funds.
And even though you've got flexibility to a degree in regards to what you can and can't invest in that document, it is a legal document at the end of the day. And there's a very clear structure and way that needs to be presented and discussed when preparing that document, isn't it?
Exactly right. Exactly right.
So again, not something you want to make sure you've got some advice in relation to how to do that. But as it said there, I mean, your investment choices, we've talked about property, we've talked about some direct assets. The gold art was always the example that came across. Crypto obviously coming up a bit more nowadays. Some people want some exposure in that. So, but also some traditional choices as well. So, I mean, you've definitely got, if you're looking for the broadest investment options, I think self-managed super funds is the one that ticks that box.
Totally agree.
Yep.
It's you're effectively unlimited within reason of what you're looking to invest in, but just keep in the back of your mind anything that's not listed or a direct asset, such as art or such as gold, or a commercial property. It's fine to invest within the self-managed super fund, but it just can't be for that personal use.
Yeah, and which is the sole purpose test, isn't it?
Yep.
Explain to us what the sole purpose test is.
The sole purpose test is really just that it's your funds are inside the superannuation environment for your retirement benefit. That's effectively what it says.
Yeah, and that you can't get a personal benefit. So the question always comes up, can I buy a property in a self-managed super fund and rent it out to my child or another family member? The answer is no, because you or a related party are getting a benefit from that. So you need to keep that, make sure that is clearly for your retirement and know you can't get any other benefits out of that. So we talked about going back to tax concessions, and I think we've probably talked about this quite a bit already, but particularly in relation to franking credits, because I know with shares that does come up quite a bit. Why does a self-managed super fund really help from a franking credits perspective if you do hold direct shares?
Yeah, Australian shares are a really popular choice for a self-managed super fund because of franking credits.
Yep.
So in accumulation, obviously you're paying the tax at 15%, but once you get into that pension fund, again, within those caps, it could drop to 0% tax. So obviously the way a franking credit works is the company's already paid tax, be it at 30 cents, let's call it.
Yep.
So that in Australia, there's a double taxing system, so you don't get hit with two sets of tax, so you get that back. So if you think of yourself being in retirement, so you've triggered a retirement within your self-managed super fund, you're not paying any tax, but your Australian shares are picking up 30% in dividends. That 30% results in so if you're getting a $100 dividend, for example, it's paying $30 tax. You get a $30 franking credit. If you're not paying any tax in the self-managed super fund, you're getting a $30 tax return.
Yep, which is why, and not that I'm an expert on US tax systems, my understanding that system doesn't apply, which is why franking credits are not so much big on US or broadly international shares as well. So the case of Apple, which I believe, and maybe Berkshire Hathaway have barely paid or not even paid out a dividend before. So I mean, definitely if you're looking at Australian shares, there's some really good tax advantages there, which the right advice can really save you quite significant amounts of money. So, and let's talk about estate planning as well, because self-managed super funds can provide some estate planning benefits as well. Can you talk a little bit more about that?
Yeah, so I think simple terms, it allows you to, if you want to have a binding death nomination, for example, so pre-retirement, let's assume, it allows you to have that in place, and it can basically be set and forget unless your circumstances change. So that's available in industry and retail funds as well, but inside a self-managed super fund, you can just leave it in place, which not all funds necessarily allow. Once you reach retirement, you can nominate a reversionary beneficiary, which the big benefit here as well is obviously the self-managed super fund is fully invested. There's no need to sell down investments. They can be held within that fund and pay a retirement income as a reversionary to the surviving spouse. So there can also be some longer term succession or estate planning benefits from a family perspective by bringing in those extra members like we spoke about before. So self-managed super funds, again with that key word, control, allow you to take more a proactive front with estate planning as well.
Now, let's talk about borrowing. You raised that one before. Also, particularly for those who are looking to get into property, and most people wouldn't have enough cash to buy a property outright, and even those that do, it would significantly reduce their diversification. Talk to us a bit about the borrowing, because borrowing was probably a little bit easier in self-managed super funds 5-10 years ago, but it's certainly reduced now. Is that fair?
Exactly. It's more difficult inside a self-managed super fund to get a loan compared to, say, in your personal name going and buying a factory. There's just more responsibilities on you as the trustee to get that set up. So generally speaking, we find with commercial property, you can only borrow, say, 70%. So you've got to have a decent amount of a balance to start to enable you to take advantage of that. These days, you have to set up some additional trusts in the background that enable you to get a loan within the self-managed super fund. So Is it possible? Absolutely.
Yeah.
Do all banks do it? No. There's only a number of banks that even play in that space, and that's moved over time as well. Yeah. We've found some enter the space and some move on, but it's absolutely possible. But it does require a bit of work to get that set up. And just keep in mind, because it's different to a residential loan outside of super, there are some limits on how much the borrowing capacity that you can actually get.
And also the rate as well. Usually is 1% potentially more than what you'd get for, say, a standard property investment within your personal name. That's my understanding anyway.
That's exactly right.
Yeah, so
you're paying, because of the complexity, it's more work on both fronts. So banks do charge you a little bit more as well.
Yeah. So something to be very mindful of as well. So again, these are complicated, and within that complexity, there is opportunities, but there are also things to be mindful of as well. So making sure that you've got the right advice, the right plan in place to take advantage of that and avoid some of those pitfalls is just very crucially important.
And I'll just touch on borrowing as well there with so for example, if you buy a property, there's rules around what you can actually do with that property inside a self-managed super fund. So if you want to do a renovation, for example, you can absolutely restore or replace a kitchen, for example, if it's through wear and tear, but making amendments to the home, adding an extra bedroom, there's rules around your ability to be able to do that. So outside of super, it's definitely easier than inside a self-managed super fund, but a self-managed super fund obviously provides that alternative method for funding whatever investment option you're looking to achieve.
Yep. So if you're buy and hold, then a self-managed super fund could, property investor that is, a self-managed super fund could be the right thing for you. But if you're someone who likes to do development, renovations, add rooms, land splitting, then maybe it's not the right option for you. So again, a lot of complexities, a lot of nuances. Chatting through your options is just so important. So I guess, should I set up a self-managed super fund? I guess we've listed a couple of questions there, but what should individuals or those listening to this be asking themselves whether a self-managed super fund is right for them?
The first question is why? Why am I doing this? Is it to take more control? Is it to allow you to invest in options that aren't available within the normal superannuation environment? So really, that's the most important question, why, because undoubtedly it's more time consuming. The self-managed super funds that we shut down tend to be the client says, look, I'm sick of doing the paperwork. I just want this to be easy. So that's a key consideration for individuals. But largely it's around your why as to, are you looking to invest in property? So you've got a property bias that obviously, that's the only way you can get exposure to direct assets in Australia via the superannuation environment. Yep,
and that why is so important. And can that why be met with a self-managed super fund, or is there another simpler vehicle that might meet that need? And as we discussed before, like a self-managed super fund would have been right 10 years ago for some people, but now with a lot of these changes, it may not be the right option for them.
And to go back to gold, because that was a unique case for myself. These days, there's exchange traded funds.
Yes.
So Patrick, I believe, did a webinar on exchange traded funds. So watch that one if you'd like some further information. But these days, you can get exchange traded funds that track the gold price. Now, there's a number of them available, so look under the hood before you invest. But essentially, if you wanted to buy direct gold, you could do so via an exchange traded fund compared to actually buying that gold yourself and going through the requirements to get it stored in Perth or wherever you choose to store that. So there can be alternative methods that you might not have thought of before setting up a self-managed super fund. And that's why it's really important to engage your key support people, your financial advisor or your accountant, whoever it may be, to just run through what your options may be.
ETF sounds a lot simpler than holding gold and paying for a storage unit somewhere.
It does.
Yes. Now, a question on the PowerPoint there, I think it's a really important one. How much do I need in super to make an SMSF viable? So obviously that's a very personal situation, depends what you're doing, but there is some guidelines, both that are, let's say, industry standard, but also directed from our regulators in regards to how much you need in super to make it viable. Can you talk a little bit more into that?
Yeah, so over time, and particularly in my previous roles, I've seen a little bit of everything. So there's no right answer for any particular individual, but by and large, we suggest anything below 200,000 makes it really difficult to justify the cost of a self-managed super fund.
Yep.
Now, circumstances may permit where there's reasons why you might choose to do it below that level, but we tend to find anything below 200 is not probably worth the time, effort, and cost.
Yep.
Generally speaking, we find 300,000 to 500,000 is the more common number we see.
Yep.
Because it is a big requirement to go down the path of a self-managed super fund. And if you think of borrowing capacity within a self-managed super fund as well, obviously you want to make sure you've got a balance that's healthy enough to allow you to do that.
Yes.
So if you're less than 300,000, it does make it a little bit more difficult.
And you've touched on an important point there. That's 300,000 of, let's say, what you've got. So even if you use that to buy a $900,000 property, for example, we're not looking at how much the property is valued. If you've got a $600,000 loan,
Yep.
It's the actual equity or the value that you've got that determines that $250,000 limit. So
exactly right.
If you think you've got 100 grand, put a deposit on a property and happy days, away you go. No, sorry, it needs to be 250, 300 before. Again, not in all situations, but in most situations, it becomes financially viable and appropriate for you to go down that path.
Correct. And just keep in mind, that's across all members within the self-managed super fund.
Yep.
So if you're two members joining the fund, it's both your balances combined.
Yeah, and that's important because I think I'm seeing a lot more those in their, well, we're both in our mid-30s that have got 100 grand in their super, 100 to 150, depends on family, careers, and a few other things. So by themselves, it's probably not enough, but provided together they get close, and if they've got other family members or friends that they're close with, that you can get 4 of them. That's where you can get your that balance enough to make an SMSF viable.
Yeah, I'll take that mid-30s comment as a compliment. Thank you, Chris.
Yes.
And just be careful whenever you're consolidating these funds. Just be aware that you might have insurance within your other funds, and that again comes back to the need just to make sure you've got the appropriate support around you before you rush off and do anything in this space.
Yeah, very important to make sure that regardless of your super arrangements, that you've got a good plan B or personal insurance cover in place. So let's talk about a bit numbers. So, I mean, we've pulled these up from Rice Warner, but in your experience, talk us through these fees and what do you think a self-managed super fund does cost to set up and then run? Yeah,
so obviously these are from Rice Warner, as Chris mentioned, so they should be reasonably accurate.
Yeah.
It depends on the accountant that's assisting you, by and large. Some of those costs are set, the ASIC fee, for example, but it really comes down to the accountant that you're working with. We tend to find probably the mid to high range is around about where we see self-managed super funds costs.
Yeah.
Very rarely have I seen too many self-managed super funds set up for $1,500.
Yeah. I guess there is some online providers that do it on the cheap or for free, but I mean, you've got to have probably a higher knowledge of what you're doing to make sure that is the right option for you. Yes, going through an accountant might be more expensive, but you need to make sure it's set up right because what we say, there's a cost of advice and there's a cost of ignorance.
Exactly.
And if you get this wrong with a self-managed super fund, it can be very expensive. So, and then the ongoing compliance administration costs. Can you just run through what some of those things listed there are and whether they're going to be appropriate for someone's situation?
Yeah, so the main thing is going back to what we spoke about at the start. A self-managed super fund, you're in control of it. As the trustee, you are now responsible for preparing the financial reports via your accountant, generally speaking. So you have to pay for the cost of the administration of that fund. So the accountant compared to your industry, your retail, your wrap account, where the provider does all the work in the background of processing dividends, processing capital gains, processing buy and sales of shares. In a self-managed super fund, the accountant does all the administration in the background for you. So there's a cost involved in that. The fund needs to be audited as well. So that's naturally another charge. But generally speaking, we see those costs. The costs on the screen there, which are from Rice Warner as well, are pretty consistent.
Yep.
It depends on the complexity and the amount of transactions you're doing as well. So if you're someone that's a day trader, your accountant's probably not going to like you very much, just because the amount of transactions they have to work through in their system to process that.
Yeah.
So the complexity and the frequency of transactions really dictate the cost of the administration side of that fund. So I think on the screen there is reasonably is a reasonable consideration for ongoing costs, and think of the bottom end as a fairly simple self-managed super fund, and the higher end there being a more complex, more frequent trading account.
Yeah, that makes sense. Why use a financial planner for a self-managed super fund? I mean, if I'm someone that wants to have control, got, let's say, a fair idea as to what I'm doing and what I want to achieve with my self-managed super fund, why should I engage a financial planner?
Yeah, so financial advice, first and foremost, it's not for everyone, but for a component of the population, it's a really valuable resource to lean on. What it allows you to do is to get that expertise and knowledge to make informed and correct decisions for your situation.
Yep.
Whenever you're managing your own money, there's risks involved in that. If we spoke about before, rolling into a self-managed super fund and not considering insurance, for example, it just allows you to take the stress away from making mistakes, but most importantly, allowing you to make informed decisions with how you position yourself for now and into the future. There's a range of benefits. We had a post that'll go out today about the value of advice. Being a financial advisor generally returns about 5.9% to a client's overall financial position, but I think if you're going down the path of a self-managed super fund, it's really important that you get it right. And a financial advisor can help make informed decisions around where you invest your money. On top of that, there's naturally goals and objectives that we help clients with working out. So in particular, that why that we spoke about before. Because there's stuff that as an investor, you're not necessarily aware of everything that's available. We can talk you through that as well, and building out those goals and objectives for the long term to make sure we've got your investments housed how we want them to be for your long-term benefit. There's also the tax advantages that we can take advantage of, such as making sure we put a little bit more away. The reality is some people are really good savers, most of us aren't, and time gets the better of us. So a financial advisor really allows you to have someone in your corner that's assisting you on your journey to take advantage of strategies, investments that are valuable for your situation. Yeah,
and I mean, even if you've got a clear strategy, for example, you're self-employed, want to buy the factory that you're working out of, that formulates probably about 20%, pulling a number out of the air kind of, but let's say a very small component of the overall picture of not just a self-managed super fund, but your entire financial position as well. And that's where a financial advisor can come in to look at the full picture. And for example, you're looking to buy a commercial property, fantastic. Have you thought about your risk management? Have you thought about your tax strategies? Have you talked about your borrowing capacity and how to fund that? All those things that, you might have a clear goal, which is fantastic, but to get to that point, there's quite a few steps that most people would not have been aware of.
Agree.
So I always say, look, you can't outsource your physical health. You got to do your push-ups, all that kind of stuff, and very clear that I don't. But you can outsource a lot of the financial side of things, and I think the greatest asset that you've got is not so much your finances, it's actually time. So if you can palm a lot of this off to someone else, you've got a clear goal and what you want to achieve, fantastic. Pass it on to someone else who can manage that side of things for you, so you don't have to worry about it as well. So excellent stuff. Like I said, if you are getting benefit out of this video, give us a like, subscribe, leave a comment, let us know. If you've got any more questions, please let us know. But if someone wants to talk about this in a bit more detail, what should they do next, Tyson?
Jump on the website. Book an appointment with one of the team. We've got a few self-managed super fund specialists at Vista and Master Your Money Now available to have a complimentary 15-minute chat for a start. That'll allow you to get a feel for who we are, and we can get some insights into your situation and where we might be able to assist. So let's have a chat, see if we're the right fit for you, and whether a self-managed super fund or not is the right fit for you. And from there, we can discuss your what the next steps would be for you, and we're putting those that link in the comments below as well. So, but that's all we've got. So again, check out our previous webinars as well. They're on our YouTube channel, but they'll also be on our website as well. Tyson mentioned Patrick's webinar that we did, From Saving to Investing, for those who are looking to understand their investment options. Building a house that we've done in the past as well, and also with our mortgage broker Shane Maloney, as we're recording this late in 2023,
interest rates are high. What are some of your options? We don't really touch on self-managed super fund lending in that webinar, but we can, if you've got some other sort of lending, which most of us do, then we can certainly discuss those options as well. But if there's anything we can help you do to achieve your tomorrow, then we'd love to have a chat about your options. But again, thank you so much for your time, which we do respect and really appreciate you've taken 30, 40 minutes out of your very busy schedules to listen to whether a self-managed super fund is the right thing for you. Thank you, Tyson, for sharing your wisdom and expertise. It's always greatly appreciated.
Thanks for having me.
And again, we're looking forward to seeing you at the next webinar that we run. Bye for now.
See you guys.